Cramer. Welcome to Mad Money. Welcome to Cramerica. My friends, I'm just trying to make you a little bit of money. My job is not just to entertain you, but to educate, to do some teaching. Call me 1-800-743-CNBC. Tweet me at Jim Cramer. The regular economy got a little help today. It was the help it needed. A quarter-point rate cut from the Fed, which should immediately translate into lower borrowing costs for a variety of shorter-term loans, although not necessarily longer-term ones because those are set by the actual bond market. Still, we'll take all the help we can get at a time when the consumer seems to be balking at larger purchases, vacations, even steak dinners, because they fear they might lose their jobs, and costs have gone up so much because of inflation. Thoughtful Fed Chief Jay Powell made it clear that the Fed may not cut again next month, may not. And I think that sudden circumspect attitude really did club the averages. Dow ultimately sinking 74 points after being up most of the day. S&P ending minimally down. Nasdaq still gaining 0.55% after being much higher, though, in the session. Now, you might think it's crazy for people to be worried about their jobs with the unemployment rate so low and the president cracking down on immigration. But we're now seeing a reckoning of sorts where everybody's worried about their jobs because of, yes, artificial intelligence. The epicenter of the worry, the sun around which all anxiety revolves, is the $5 trillion NVIDIA, one of my two favorite stocks, as you know, along with Apple, which reports tomorrow. And as far as I can see, the angst seems shorter-term avoidable, but only if the people at the top of your company recognize that NVIDIA is simply an intellectual engine that makes you more productive, smarter, thinking better, so you can go create things at an even lower cost than before the AI revolution. You just might not know it. Yes, indeed, Cramer Uber fave Alex Karp from Palantir. Hey, it's all in how to make money in any market. I mean it. Yesterday, on our air, did acknowledge that there could be people left behind by AI, but they shouldn't be left behind if they could heed the thunder and do the pivot. Many of today's execs think there's only a run game. When the AI forward passes their arsenal, they just can't figure out how to use it. Take the three behemoths that reported tonight because they've gone all in AI: Alphabet, Meta, and Microsoft. Now, a few years ago, all three of these companies seemed that they were headed for irrelevance, but they refused to let that happen. Alphabet, parent of Google, wasn't content to just dominate search. Instead, they integrated Gemini, their generative AI platform. Had a couple laughs and bugs at the beginning, but oh wow, it's doing terrific. When I look at the numbers today, I think they're like the Carpenters. They've only just begun. And Meta, wasn't it just glorified advertising site? Well, they embraced AI like none other, spending a fortune. We're going to be more on that in a second. They are still trying to dominate, as always. And how were the report cards for these stocks? Well, this is interesting. It's tricky. See, we don't have all the conference call niceties. At Microsoft, for instance, their call is so late that it starts pretty much when we're doing the show. It's like election night says. Let me give you some early returns. Alphabet shot the lights out with their revenue growth accelerating for the third straight quarter to 16%, much better than expected, and the company earning $2.87. Wall Street was only looking for $2.27, and that's why that stock is flying in after hours. You know, I think it's terrific, regretfully, because I told you the trust sold it. When you drill down, Alphabet's still firing on all cylinders. Their core search business is up 15%, no cannibalism from Gemini. Their generative AI platform is doing so well. At the same time, Google Cloud revenue beat expectations by over $500 million, up 34%. Fantastic. Margins were better than expected when you back out $3.5 billion one-time charge. European fine. And Alphabet's capital expenditures were in line. It was really good. And I got to tell you, it's going to be the star. It's going to be the one that people are going to think about now. For the benchmark of these stocks, even the amount of money that they spent didn't derail anything. They're on fire, just plain out on fire. Now, the one that is trickiest is Meta. Even though their revenue was much better than expected, their earnings took a huge temporary hit for the president's One Big Beautiful Bill Act, led to a colossal earnings miss. But according to Meta, this is a one-time thing, and their tax bill will be a heck of a lot lower. If not for a one-time hit, well, they would have earned $7.25 per share. That's much better than $6.72 that Wall Street was looking for. At the same time, they raised their full-year revenue forecast, but they also raised the full-year capital expenditure forecast by even more, and that's therefore not as good as what Google did. They're spending more than what Google did, and that's what people are thinking about, okay? I've got to tell you, if you throw in the fact that the stock was up 28% going into the quarter, and you can't understand why the stock got clobbered after hours. It was up too much. I think it's an overreaction. I am drilling down, and club members, you will get a concise, to-the-point bulletin tonight about where I stand with this potential opportunity. Microsoft, reported what I thought was a truly strong quarter. Not only did Microsoft deliver a top and bottom line beat, but their all-important cloud infrastructure division, Azure, saw its growth accelerate to 40%. That said, the stock still got hit in after hours because I think it came in too hot. Remember, Microsoft shares caught fire earlier this week after their deal with OpenAI gave them that 27% stake in the for-profit part of the company. If it hadn't already run, I think Wall Street would have been fine. It might even been a bit of a yawner, frankly. More to come later tonight for club members. Finally, as I said earlier, the Fed's rate cut will make things easier for the real economy. But let me put my entrepreneur hat on for a second. The one I wore when I created a bunch of companies over a multi-decade period, some of which were even successful. First, many of the companies in the so-called real economy have only themselves to blame for missing out on the data center boom. Today, Caterpillar reported the stock shot up more than 11%. Why? You know why? Because previous CEO Jim Cramer decided that he was going to make that company perennially cyclical, perennially boom and bust, into a secular growth story by emphasizing turbines and power equipment. And what were the star divisions? Turbines and power equipment. And that's how you get a stock higher. The division that provides power, amazing, the one that he presided over. Sure, you need CAT construction equipment to build a ton of things, but you especially need power for the data center. Bumblebee saw it coming. That means a visionary. But then you take a look at Generac. Well, what do? They're the maker of backup generators with some data center exposure, even though it's clearly not enough because the stock got slammed today in response to a not-so-hot quarter. They even cut their forecast because, in the end, Generac's core business is making generators you can use during a natural disaster, and haven't been enough natural disasters. Unlike CAT, these guys did an all-in pivot to become a more secular growth story. They didn't bet big enough on the data center. That wasn't smart. A few companies in America were like CAT. Most were like Generac. And a quarter-point rate cut won't make enough difference if you have the wrong strategy or if you're late to a better one. Here's the bottom line. This rate cut is great news for the so-called real economy that I keep telling you about is down in the dumps. But as you can see from Caterpillar, the best-performing companies in the real economy are the ones that also have a ton of exposure to the data center economy. And as for tonight's Superstock Parade, Alphabet's the winner. Microsoft's trying to take second place. And Meta's looking like it's came in first, but it's last out at the finish line. Ty in Arizona. Ty.
Professor Cramer, how are you?
I'm good, Ty. How are you?
I can't be any better now that I'm talking to you. I want to say thank you so much for writing the book. I listen to it every day on Spotify,
thank
which
you.
I'm a shareholder
How about
of.
the way I did that? I sound so Kramer, meaning I sound so Philadelphian. I apologize to the world for my Philadelphia accent, but my mom's was even worse. Okay.
No, you're perfect. I can't tell you how much I'm thankful for it. I start my day with you, David, and Carl on Squawk on the Street, and then I finish it taking a shower, listening to you through Spotify. So thank you for doing that.
Okay, I was going to say that, that might be close enough in terms of our contact, but that's great. I appreciate that. And, look, what can I tell you? We play for you. You are my boss. How about that? If I don't play for dinner, I play for you. Okay.
I got a question I need some help with, and you've helped me tons before, and you even helped me with this one. I think Squary's in over his head at American Express. I want to swap it for Klarna. What do you think?
No, I won't let you do that. I don't think Squary's in over his head at all. I think he's actually I think he, in his own way, is a genius. He's figured out what younger people want. I was just funny. I reactivated my platinum card yesterday, and I said, you know what? Squary, he just figured it out. He makes us happy. I think he's a very good executive. Klarna's fine, but Squary, let's just say he's figured it out. I'm going to, I hope maybe it could be the same, Sully in New York. Sully. Hey, Sully.
Booyah, Jimbo.
Booyah.
Man of the hour. Thank you for all your hard work, man. Always tune in to watch Squawk on the Street. You, Mr. Faber, Mr. Quintanilla.
Yes, we work hard on that show. I brought a big basket of research down there just in case Faber was trying to nail me on something. You know, sometimes he gives me a hard time. I never give him a hard time. What's that all about? Maybe we have to get a psychiatrist and have 4 people.
Always a good watch.
Thank you.
Thank you, sir. Don't want to take too much of your time, man. I'm a big believer in this term. Yes, I'm a big believer in this stock long term, but short term has been killing me, man. It's DraftKings, DKNG. Want your opinion on it? And
well, look, I happen to like DraftKings very much. Now, the problem is, obviously, that the people are beginning to worry whether gambling, again, is honest. I think gambling is honest. I think Jason Robbins is honest. I think there's always going to be dishonesty and fraud wherever you go. You can't game fraud. It does occur. And I just think that it's just something that happens. But the DraftKings, if they get Texas, Florida, and California, wow, it'll be terrific. All right, look, the real economy got the rate cut it needed today. We can take that, whatever we can do for that real economy. And as for Microsoft, I don't know, Meta, and Alphabet, great. Mad Money tonight. We've got an action-packed lineup of guests, starting with ServiceNow. The enterprise software powerhouse reported after the bell, but is now the time to strike? I'm going to find out what the company's top brass. Then I'm taking a bite out of Brinker's earnings. I mean, geez, these restaurant stocks keep getting hit. And don't miss my conversation with CEO. Maybe we can figure it out. And Otis is going up after the elevator maker's top and bottom line beat. I'm going to get an update on the state of the construction at home and abroad. And, of course, the service opportunities for the company's bankable CEO. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.